Welcome to our channel. My name is O'Brien and I would like to thank you for watching this video. If you find value in it, please like and subscribe. And if you have any questions, please put it in the comment area below. Thanks again for watching.
Lastly, we're going to learn how to measure market breadth, okay? And this is going to be with a tool called the Advanced Decline Line. And essentially market breadth, it measures the participation of stocks in a certain rally or a certain decline. Or in other words, for every rally, how many stocks are actually participating in that rally versus how many stocks are not, okay? And this is very important, especially in today's environment where we see this, we've been in a bull run for the last decade or so. And you know, you can, of course, break that down. Technical analysis is very fractal. So the same patterns you can encounter in a minute, hour, daily, weekly, monthly, etc. But all in all, we've been in this amazing bull run, and I don't think it's going to stop anytime soon. But let's go ahead and kick it off. So the advanced decline line, or breadth, is a technical indicator that plots the difference between the number of advancing and declining stocks on a daily basis. The indicator is cumulative, again, with a positive number being added to the prior number, or if the number is negative, it is subtracted from the prior number. Therefore, it is a breadth indicator used to show how many stocks are actually participating in a rally or in a decline. The goal is to identify confirmations or divergences in the overall trend. So why is breadth important, guys? Let's just switch to something very interesting. The NYSE Composite Index. Okay, so this is an index that is you know, at least not very much used here in the Dorian Way, but still very popular. This is an index of all the stocks that are traded in the NYSE exchange. Okay, the NYSE exchange has roughly around a little over 2,000 stocks. Okay, and the breadth just measures, okay, in this rally or in this current trend, are out of all these stocks, how many of these stocks are actually participating in that rally or in that bull trend? Some of these indices are cap weighted or market cap weighted, meaning that just a few players, say the Apples, the Microsoft, the Amazons, the ones with a bigger market cap, can pull more than the little guys down here, say that, you know, the bottom 1,000 or 1,500 little players that may not have the power to move an index. So that's why sometimes you'll see the breadth or the market not being as positive, meaning just a few players are pulling that thing up instead of everybody in conjunction making new highs or making advancements. So again, we go back to our studies and we go to advance and decline. It's called advanced decline, and it is by default, it is set up to the NYSE. And now you might ask, you know, why the NYSE and not the S&P 500? Well, in here, the options that are given into the Thinkorswim are just 3 exchanges, right? These are exchanges and the other ones are indices. 2 different things. However, in here, for measuring the breadth, we can only measure it in 3 exchanges. And we'll go over that, right? The NYSE, the NASDAQ, and then the AMEX, the American Stock Exchange. And then you want to compare apples to apples. You don't want to say plot the advanced decline or the breadth line for the NYSE and then look at the S&P 500 chart, because it might not be the same stocks, therefore it might not be the same behavior. You want, in this case, we'll look apples to apples. And let's actually do a little bit, this line a little bit thicker so it's easier on our eyes. So what do we see here? So we see as the trend develops and the trend starts to go up into this composite index over the last year, so is the participation of its stocks, right? when you see a little green line, it means more stocks advanced than those declined, okay? And when you see a red sort of pieces, more stocks actually decline than those that advanced. We see a pretty linear correlation in between, these two assets, right? So the index and then the market breadth. Now, what are we looking for in a study like this? Well, again, we're looking for confirmations or divergences. Just in the last, again, month and a half, we can see actually a confirmation of the breadth to the index, to the NYSE, meaning that it's been making higher highs, okay? This was a high back then. Then we see another high here, and then most recently another high. And therefore, we can see that more stocks are constantly pushing and advancing this index. And also, we can confirm that by looking at advances here. So we see one peak here, we see a higher high, and then yet another higher high today on this index, right? And these are the basics of a trend, right? Higher highs and in this case, higher lows, right? So we have a higher low, and we're yet to see another higher low. So this in this case is looking, but how do we spot something like a divergence, right? We would go to say something like the NDX, which is the Nasdaq 100 index. And this was what I was talking about earlier, where you got to be careful to change. If you're going to do an analysis on breadth, you want to, again, do apples to apples. Here, we would be comparing the stocks weighted on the NYSE versus the Nasdaq, which is Nasdaq 100 are technology stocks, right? And it's a totally different game. So in this case, if we go back to our studies and we click on this little gear, we can actually select here where it says exchange. We can select, and we're given just 3 options, which exchange we want to do the study on, right? So in this case was the NYSE, but it also gives us the Nasdaq. And if we click OK, apply and OK, now we're doing apples to apples. Now we're comparing the breadth on the Nasdaq against the NDX or Nasdaq 100 index. And what do we see here? We actually see a negative divergence into the last few weeks of the behavior of the Nasdaq. How do we spot that? Well, we see that the rate of advances peaked here, okay, and of course it dropped along with this little drop here. But what has happened over the last few weeks? Well, we see lower highs being formed on the ADX or the breadth line, but we actually see higher highs forming on the index. What does this mean? Well, this means that whenever the stock is the index is advancing, fewer underlines are making it happen. So fewer underlines are actually pulling ahead and making this index appear as if everything is going fine, but it may be 10%, 20% of the participants just pulling ahead while all the other ones are not necessarily making new highs, and that is usually a sign of exhaustion in the short term. So what could happen here? Well, we might see a little bit of a pullback in the technology stocks over the next weeks, but again, no indicator is sort of this crystal ball. As soon as you see here, you'll say, oh, this is going to drop, guaranteed. Nothing is guaranteed, but again, this stacks the odds in your favor to see a potential reversal on this, okay, whenever there's a divergence. Let's see, I think there was another positive divergence. This is a negative divergence, by the way. Whenever this is making lower highs and the index making higher highs, that is a negative divergence. But a positive divergence would be something like, if we go back to November the 9th, okay. Let's zoom in into this little bit of piece of data here. Okay, and here. What do we see here? So back in November, so around November the 5th, the 6th, and the 9th, we saw that the breath line was actually making new highs, or it was advancing. Okay, so more stocks were advancing than others, but yet we saw a decline on the Nasdaq. So we see that in here, this was the weekend, right? So on Friday, it closed red. So more stocks were declining than those were advancing, yet the index remained sort of green, right? What we saw Monday morning was this huge drop here, subsequently followed by another small drop. But we saw that the breath line did not drop as in correlation with the index. What does that tell us? So, well, that tells us that the drop wasn't completely sustained. There wasn't momentum on that drop. It might have been just a few players, offloading some stocks, but it wasn't a systemic selling, pressure selling that we've seen in other occasions. So whenever this is in case this is a positive divergence, the price is falling while the indicator is actually rising, and the indicator is therefore refuting to confirm this downtrend. So that's why we saw a subsequent pickup in prices and momentum. Of course, these things develop over the course of several days. This doesn't happen, in the midst of the moment. Of course, that you may not be looking at this indicator and saying, oh, it might rebound by next week. But when you take a step back and you actually look into the daily and what's happening into the daily, you see that if you're able to identify the pickup in breadth, so more stocks are advancing than those declining, and the price is declining, there may be a possibility for a subsequent little rally in the next couple of days. And sure thing it did, right? So in this case, this is a positive divergence. Again, we saw a negative divergence right here on the most recent example, and we saw on the NYSE, on the NYA Composite Index, we also saw a positive divergence. I'm sorry, confirmation. And let's see. We saw confirmation making higher highs on the breadth line and then higher highs on the actual index. So that is the way to play this. Again, as Ernie said, you want to sort of do these things with a swing trading mindset versus day trading. It's gonna serve you better, because in the midst of the moment when you're day trading, there's so much volatility that you might be making the wrong decisions because you're not seeing the full picture, right? For day trading, there are other indicators that you can use, right? Moving average, crossovers, exponential, moving average, things that are faster. Even the fast stochastic could work. But for things like this, you want to look at it in the macro perspective